For foreign-owned companies in Shanghai, tax compliance is a core part of lawful and stable business operations. 1. Corporate income tax. The standard corporate income tax rate in China is 25%. Foreign-owned companies are generally required to make monthly or quarterly provisional filings, followed by an annual CIT reconciliation. While some enterprises may qualify for preferential treatment depending on industry or status, 25% remains the general benchmark. 2. Value-added taxes. Value-added tax is another major compliance obligation. Filing may be monthly or quarterly, depending on taxpayer status. In practice, VAT compliance is closely tied to FAPO management, invoice issuance, and input tax deduction support. Proper invoice control is essential, as errors may affect both filing accuracy and deductible input via rates for 2025 to 2026. 1. Standard rate, 13%. Most goods, 2.9% for certain items, for example, construction, transport. 3.6% for services, for example, consulting, IT. 3. Individual income tax and payroll obligations. If the company employs staffs in Shanghai, it must withhold individual income tax (IIT) on salaries. The company is responsible for calculating, declaring, and remitting IIT for employees, while also maintaining proper payroll records, contracts, and supporting documents. 4. Social insurance and housing fund. In addition to IIT withholding, employers are generally required contribute to the statutory employee benefit system, including pension insurance, medical insurance, unemployment insurance, work injury insurance, maternity insurance, housing fund. Since local contribution bases and ratios may change, companies should keep payroll and HR compliance aligned with the latest Shanghai requirements. 5. Withholding tax on cross-border payments. When a Shanghai foreign-owned company makes payments to an overseas parent or related party, withholding tax may apply. This is especially relevant to dividends, interest, royalties, and certain service fees or other China-sourced payments. In many cases, the standard withholding tax rate is 10%, unless a lower treaty rate is available under an applicable double taxation agreement. Before remitting funds overseas, companies should review the nature of the payment, supporting agreements, tax treatment, and any treaty filing requirements. 6. Common compliance risk areas. In practice, the most common tax compliance risks for foreign-owned companies in Shanghai include late filing, inaccurate VAT declaration, weak invoice management, payroll and social insurance inconsistencies, unsupported related party charges, and cross-border remittances without sufficient tax documentation. These issues may lead to tax adjustments, late payment surcharges, administrative penalties, or operational difficulties later on. Proper tax compliance is not just about avoiding penalties. It also helps foreign-owned companies maintain smooth operations, reduce regulatory risk, improve financial transparency, facilitate profit repatriation, and support long-term growth in China. For foreign investors entering the Shanghai market, understanding these obligations early is essential to building a compliant and sustainable business presence. If you have further questions, contact Shanghai Tenet.